year, and the compliance requirements would certainly be narrowed down. They have already announced that the SEZ Act would be completely governed online with the customs portal. So in terms of the coverage would be enhanced significantly. They want to include special enclaves into the SEZ Act and certainly make it more IT driven. So how it will basically come up, we don't know. But this is a very important year for exporters because a new SEZ Act and a new foreign trade policy, we know that the foreign trade policy, the old one is being extended by 1 year every time. So again, March 2022 it is due to get renewed. So the new foreign trade policy and the new SEZ Act, this will be a complete game changer for the exporters in India. So with this, I complete the updates on the indirect side. I think I've just used a bit more of the time which is allocated to me. So I now give the mic to 𝐁𝐮, who will now discuss the direct tax changes.
Thanks, Anand, for summarizing indirect tax changes. So I'll take you through direct tax proposals. Can we move to the next slide? Yes. So everybody knows no changes in tax rates, and the question may arise, okay, if there is no change in tax rate, is there really anything to discuss? But let's see what are the changes, some of the important changes were captured in subsequent slides. So next slide, please. So as you all will be aware, the new manufacturing companies are eligible for a concessional tax rate of 15%. So the timeline to start the manufacturing was set as 31 March 2023. And looking at COVID situation, there may be delays in plans to set up the manufacturing facility. And that's why this date has been extended by 1 more year to 31 March 2024. So now if you set up the new operations manufacturing facility by 2024, that should still be eligible for concessional tax rate. Then for startups also same way, they have extended by 1 more year. So startups are eligible for 100% deduction of their profits for 3 years. So now they have been there was a timeline of 31 March 2022 to start the business, and now it has been extended by 1 more year to 31 March 2023. Next slide, please. Yes. So there have been certain changes which kind of try to reduce some of the tax litigation points. These are both some of the changes which help taxpayers, some of the changes which don't help taxpayers. So first and foremost is deductibility of education cess. So we know, like when we calculate income tax liability on our income, there is a surcharge and then there is the education cess. So the education cess, since it is not called specifically as income tax or surcharge, then whether really it should be deductible, because we know that income tax is not deductible by way of a specific provision. So what happens about education cess? So there has been a kind of lot of rulings which have held that the education cess should be deductible. So now that has been sought to be nullified with a retrospective effect right from AY 2005 2006 when the cess was introduced. Now this provision specifically clarifies that this amount will not be deductible. So the amount may not be significant for many companies, because if you say 100 crore is the turnover and 10% is profit, so which comes to 10 crore, the likely impact of tax on such cess is going to be less than 5 lakh. So that's how it is not very significant unless until the operations are big and the tax liability is significant. So that was then. Then next is the section 14A related disallowance. Again, this is more relevant when there is an exempt income, say that is earned. So earlier it used to be a dividend income. So dividend used to be exempt in the hands of shareholders. So such income was earned. Then any expense for earning such income was disallowed. So courts had held that if there is no exempt income in any particular year, then there should be no disallowance. So that is also sought to be that anomaly is sought to be removed. And so even if in 1 year you don't have exempt income, but some other year you may have, and that's why whatever expense you incur to earn such income is going to be disallowed, whether in that particular year there is an exempt income or not. Then in case of amalgamation demerger, again some clarity is brought in that there was because amalgamation demergers can take a couple of years to get a final approval. and then there is no timeline to revise the returns. So now they have given a 6-month timeline to revise the returns in such cases. Same way, in case of assessments, what happens is that if there is a predecessor who has gone out of existence, then whatever orders may have got passed in his name may become invalid. To protect those orders, they have said that till the time the process is going on, if any orders are passed on predecessor, they will also be valid on the successor of the business. We can move to the next slide. Then there are also some more amendments which seeks to reduce litigation on same lines. So one is the deduction under 37 for business expenditure. It is said that like this is more relevant for pharma company where any kind of freebies etc. are given to medical practitioners, and that is against the guidelines set by the association for such practitioners. Then those expenses were still there was a debate whether it should be deductible or not. So that is sought to be clarified that it will be not deductible. Same way, any expenditure in connection with offense under law is not deductible. So it is clarified that even if it is offense under outside law outside India, that will not be deductible. Then in respect of 43B provisions, which allow certain expenses on payment basis. So in case of any interest that is payable to any financial institution, NBFC, bank, then that is generally deductible only on payment basis. So in case in case any company is trying to convert this interest in the debentures or any similar kind of instruments, then certain rulings are held that this will be deductible because this is a discharge of interest when you convert it to debenture. So that is thought to be again nullified, these kind of rulings, to say that even if you convert interest into such instruments, still it will not be considered as paid, and that's why deduction should not be allowed. Then another change is in respect of deferral of filing of appeal by department. So we know that there are a lot of issues which are in front of courts and it takes years to get the ruling. Now what happens till the time you don't get a ruling on such issue, if it is a question of law, then any other taxpayer who is facing similar issue will again have a similar challenge, that there will be multiplicity of appeals by every taxpayer for every year. So to reduce this issue, what is sort of, if there is an identical question of law that is in front of any higher forum, then tax officers will not file the appeal in such cases after taking consent from the taxpayer. So once the issue is finally decided, then all these other matters will also be taken up appropriately. So this should somewhere help to reduce litigation and to reduce the cost that taxpayers incur on repetitive litigation. Then there are certain other clarification, like there was an amendment in goodwill last year, so there is a additional clarity provided on some of the aspects that were missed out. Same way, slum cell definition was changed last year, so there is a consequential amendment that was missed out last year, so that has been again brought in. These two changes have been done with effect from last year. Move to the next. Yes. So now this is a very important change that has been brought this year. That is the updated tax return. So we know there is a normal return you file in timelines. There is a revised return. There is a belated return. Now there is an updated return that has come up. So here it is nothing but the taxpayer gets one more opportunity if he has missed out to furnish any information, any income for tax. Then he can file an updated return. And there is a timeline of 24 months. There are certain conditions that it should not increase the refund, or it should not be a loss return that you will file under this. So the clear idea is that you should be offering something additional, you should be paying some additional taxes, then only this return will work. Of course, if there is an ongoing assessment, there is a search. In such cases, you will not be able to do it, obviously, because otherwise taxpayers may wait if there is a proceeding has started and then they will file the updated return declaring additional income. So that is not the intention. If any proceedings are started, then you can't really go and file this updated return. It is for genuine miss outs. If you miss out something to offer, then better you go and offer it. Again, here there will be additional interest liability, and over and above tax and interest, there will be you have to pay additional amount of 25% or 50% depending on when you file. So if you are filing within 12 months, the updated return, then there is a 25% additional premium that you need to pay. And if it is after 12 months but before 24 months, then it has to be 50% over and above the tax and interest amount that has to be paid. So we can move to the next slide. Yes. So then probably you'll be aware that last year there was a provision introduced that higher rate of TDS or TCS will apply in case the other party whom you are either making a payment or you are receiving a payment from, which are covered for TDS or TCS purposes, and they have not filed return for 2 years. Then you needed to withhold taxes at a higher rate than the rates that are specified. So this time limit of 2 years has been reduced to 1 year. So even if a person has not filed a return for 1 year, then this will apply. And in fact, the way the provision is worded, if the timeline is over for filing the return, the normal due date. So in that case also this provision will apply. So if there is a late return getting filed, in that case also for the period between the expiry of due date and late filing of return, whatever period is remaining, even for that period there will be a higher TDS or TCS will apply. So that's why the timely compliance by way of filing return will be essential. Then there is a provision regarding TDS on immovable property. So we know that if you are purchasing an immovable property, then you need to generally withhold the taxes if the amount is more than 50 lakhs. So now what has been done is, so it can be a consideration for that property or a stamp duty value, whichever is higher will have to be considered to decide TDS. So it should not happen that the deal is done at a lower price, but actually the stamp duty is higher. Then in that case, TDS should apply on a higher price. Then a new provision is thought to be introduced regarding TDS on benefits or perquisite provided to any person in the course of business or profession. So this provision is something which I think will have to be looked at carefully. What all types of payments are happening, what kind of benefit or perquisite is passed on by way of such payments, and TDS will have to be done. So this is something which I think will have to be looked at carefully. This is something which has come altogether new and probably may impact many companies. Then there is a change in penalty provision. This again may not be very relevant or very kind of very frequently encountered, but actually the per day penalty of 100 has been increased to 500 for certain kind of offences. Some of the offences that can be correlated is like TDS or TCS certificates or Form 16, such kind of documents. If they are issued late, then there will be a per day penalty of 500, which was earlier only 100. So there is a significant increase. So we can move to the next slide. Yes. So then these provisions to some extent may not be relevant. Like in case of a dividend from a foreign subsidiary, the Indian person was taxable at 15%. So this benefit has been withdrawn. Then there is a refund of tax withheld related amendment. So earlier, if any refund was to be claimed, then there was a provision to directly go and appeal before CIT appeal. So now there is a mechanism provided to appeal it, go before assessing officer and then go to the commissioner. Then there is another important changes regarding section 68, where any kind of credit in the books of accounts, if it is not properly explained, then that may be subject to tax. Now what has been sought to be done is there is a specific provision that has been brought in that in case of loan transactions, when a credit is given to other party, then if the source of income for that party, that is the lender, is not properly explained, then there could be even that amount could be considered for taxation. So this is a very significant change, and when there is any loan etc. being obtained, I think there will be more kind of documentation also need to be seen. What kind of documentation can be kept to overcome such kind of provision? Otherwise, there will be a huge tax implication that may come up. In case of liability of a director of a company, there has been a clarification that this provision only will not apply in case of liquidation, but it will generally apply in all the cases. We can move to the next slide. Tax on virtual digital asset. I think probably some of you may be kind of better placed to know this, who are actually dealing in this kind of transactions. But yeah, like there is a 30% tax introduced. The cost of acquisition will only be allowed, no setup of losses etc. from any other source, or losses of this particular transaction will not be allowed to be set off against anything else. So there is a kind of clear-cut guideline to tax it at 30%, only allow the cost of acquisition. Again, TDS will also apply on such transactions, and even gifting of such digital assets also will be liable to tax. Of course, gifts to relatives can be excluded from this specified relatives. Yeah, we move to the next slide, please. Specialist proceedings, we know like last year it has been introduced. There have been some challenges in proper implementation. So there was one of the provisions was that if the proper process is not followed, the order will be invalid. But government realized that there are a lot of issues in implementing this, and that's why that provision has been done away with. So the order will not be directly invalid. It is just that probably the procedure is not properly followed. So some kind of remedy can be done for that. But the order itself will not become invalid now. And of course, there is a provision that now mandatorily they will provide an opportunity in case you ask for it to present your case. Earlier there was kind of it was optional. We can move to the next slide. Yes. So in case of reassessment, they have kind of added some more categories. In which case it can be considered that income has escaped assessment. So that has been done. Again, they had curtailed the time limit for reopening the cases from 4 and 6 years to 3 years last time. But at the same time, they had introduced one more category where you can reopen up to 10 years in case there is a kind of some information that is available with tax office which has a more than 50 lakhs of value as escaping assessment. So some more categories have been introduced to it. So it was only in the undeclared asset was there. Now even if you are having some kind of expenditure on entries in books to the extent of 50 lakhs or more, basis which it can be decided that income has escaped assessment, then even in those cases it can be now reopened up to 10 years. So now I think somewhere it has again gone back to the old era where I think it was 4 to 6 years, 4 and 6 years. Now it is 3 and 10 years, and 10 years is generally once the value is more than 50 lakhs, 10 years. So it is actually extension of time period for reassessment cases. Yeah, we can move to the next slide, please. There are some small changes in case of transfer-pricing. So there was commissioner has powers to revise the orders of lower authorities, but for transfer-pricing there was no specific provision, so they have introduced that. Again, faceless scheme for transfer-pricing was there in pipeline, and there was a timeline up to 2022. So for now, TP and DRP proceeding they have extended it to 2024. So by 2024 they can implement this scheme after considering the experience of faceless proceeding for corporate tax assessment. We can move to the next slide, please. Yeah. So there is some change in case of insurance for dependent disabled persons that is there, and another change is in relation to COVID treatments. And so I think for this there was a clarification already brought in. So now this has been brought in by way of a specific provision in the law. So any kind of expenditure. Any kind of expenditure that is incurred for medical treatment or illness related to COVID, and that is somewhere contributed by some other person, then it will not be taxable entirely. At the same time, if there is a person who expires because of COVID and the employer helps, then that amount will be non-taxable without limit. But in case any other person grants any help, then up to 10 lakhs, that amount will be not taxable. Beyond that it will be, and there is a time limit of 12 months to get such kind of help from anybody. So yeah, so that's it from my side, and we are through with the budget proposals on direct tax side. So now I'll pass on to Soumitra for legal updates.